Hi, I'm Patu from freefincal. Because of the market rally over the last few months, the Nifty 50 equal weight index has surged past the Nifty 50. And let's look at what this means and what I'm referring to. So, the Nifty 50 is a market cap weighted index, which means that just the top 10 stocks will take up anywhere between 65 to 70% of the index weight. Instead of that, the Nifty 50 equal weight index will have all the 50 stocks having more or less the same weight. The same is true for the Nifty 100 versus the Nifty 100 equal weight index. So I had pointed out in December 2019 that the return difference between these two indices, that is the Nifty 50 equal weight index return minus the Nifty 50 index return, the return difference was at an all-time high. That is, the Nifty 50 return was so much more higher than the Nifty 50 equal weight return in December 2019, and I had said that that's clear evidence that just a few stocks were governing how the Nifty or the Sensex was behaving, and just 3 months afterwards, when the market crashed, this 2-year, 3-year kind of imbalance among the index stocks more or less was completely destroyed. And since then, there has been a resurgence very gradually, not immediately, but initially gradually, and then it has picked up. The resurgence in the Nifty 50 equal weight index has picked up quite a bit. Now, in this graph, the orange line is the Nifty 50 total returns index. The yellow line is basically 1-year return of the Nifty 50 equal weight minus 1-year return of the Nifty 50. So you can see here, this is if you look at starting from June 2016 onwards, this started moving up and became positive. Positive means Nifty 50 equal weight return, 1-year return is greater than Nifty 50 1-year return. And then it reached a peak somewhere in probably early 2017, I think February 2017, if I recollect. And that was about almost 9%, and then it started falling down. And you can see here in August 2019, February 2019, August 2018, excuse me. At that time, the return difference was minus 11%. That means the 1-year Nifty 50 return was 11% more than 1-year return of Nifty 50 equal weight. So that is a kind of disparity, and that was the dominance of the top few stocks of the Nifty. And then that persisted until the market crash, and after that, there has been kind of like a reset that has happened in the market, and the Nifty 50 equal weight index returns have increased, and now it has almost hit that 9% peak, whatever was seen in February 2017. So it's like it has touched a 4-year high, and that's very important news, particularly for active fund managers, because if the Nifty 50 is governed by just a few stocks, then active fund managers will have a very difficult time trying to beat the index, because then they must also have those dominating stocks, otherwise the returns will be low. But if the Nifty 50 equal weight index is doing well compared to the Nifty 50, that means that all the stocks in the Nifty 50 are, or at least more number of stocks are doing well. Similarly for the Nifty 100, and fund picking, active fund picking, and the chances of beating the Nifty 50 is a lot higher, and that has already happened. Because even right after the market crash, 80% of large cap funds temporarily outperformed the Nifty and the Nifty 100. And today, if you go to value research and rank large cap funds by 1-year return, you will see that the top 10 funds are dominated by the active funds. Last year, year before that, a year before that, and so on, that was not the case. That is the reason why index funds became popular. It became popular because of recent performance, or the past performance rather. And today, if you look at it, the scenario is completely changed. There are only like 1 or 2 index funds in the top 10, and those index funds are very low AUM funds, and probably the return is actually bet the index. So the situation is completely changed because of this. Whereas in the case of Nifty 100, again this is a 1 year return difference between Nifty 100 equal weight and Nifty 100, and that has also started recovering a little bit before the market crash actually, and after the market crash the recovery has been not as dramatic as the case of the Nifty 50 equal weight index, but it's still in the right direction. So it's going to be a very interesting time for active funds, and we're going to see how they're going to behave after this, assuming that the equal weight index continues to outperform the Nifty. And also you can see funds like Quantum Long-Term Equity and Value Discovery, ICICI Value Discovery, they have started performing well. Of course, Value Discovery has done a little bit better than Quantum. I had talked about this few years ago. I had said that's if you have patience with these funds, then you will be rewarded, and I think those who have been patient with these funds, they definitely have been rewarded. So this is an interesting metric in my opinion to keep track of. Bye bye.